There's a number that terrifies the most powerful oil kingdom on Earth. Not a low number, not a crash, not a collapse. The number that keeps them up at night is actually a high one, and understanding why that is will completely change how you see every alliance, every conflict, and every political move happening in the Middle East right now. Welcome to Strategic Dynamics Edge. If this is your first time here, we break down the real forces shaping global power. Not the headlines, not the spin, the economics, the history, and the strategy underneath. Hit that subscribe button right now because what we're about to cover is the kind of thing most people never connect the dots on. Let's get into it. Now before we go further, quick note, everything in this video is based on publicly documented history, economic analysis, and widely reported geopolitical research. These are complex events with many causes and many interpretations. What we're giving you is one well-supported analytical framework, not the only possible interpretation, and not a replacement for deeper reading. Think of it as a starting point, not a final verdict. With that said, let's go. Here's what almost nobody talks about when it comes to oil. The world assumes oil-rich countries are afraid of low prices. And yes, they are. But the deepest, most existential fear of Saudi Arabia, the country sitting on one of the largest proven oil reserves on the planet, is not that oil crashes to $20. It's that oil climbs so high, so fast, that the rest of the world finally decides to replace it permanently. And once that shift becomes economically self-sustaining, Saudi Arabia's leverage is gone. That's the clock they're watching. That's the game they're actually playing. To understand why, you have to go back to a hotel meeting in Doha, Qatar, in 1976. 13 men sitting in a room, representatives of the countries that collectively controlled around 70% of the world's oil supply. They were deciding how much the rest of the planet would pay to keep its cars moving, its factories running, its militaries fueled. Every major world leader was calling these men and asking, sometimes begging, them not to raise prices again. Just 4 years before this meeting, oil was $3 a barrel. By 1976, it was $12, a massive increase in a very short time. 11 of the 13 men in that room wanted to push it higher, to $13.50. The country pushing back hardest was Saudi Arabia. To understand why, you need one concept that makes everything else in this story click into place. It's called the break-even price. Every oil field in the world has one. It's simply the minimum price per barrel needed to cover what it costs to pull that oil out of the ground. A well drilled into the shale rock of West Texas might need $60 to $80 per barrel just to break even. The oil sands of Canada need even more. Saudi Arabia's field level break even, due to the geology of their reservoirs and their production methods, is estimated to be among the lowest in the world, in the range of a few dollars per barrel. The exact number varies by field and year, but by any comparison, it is dramatically cheaper than almost anywhere else. This matters enormously. It means Saudi Arabia can remain profitable at price levels that completely destroy other producers. They can fight a price war and survive when nobody else can. They've used that weapon deliberately more than once. But there's a second kind of break-even that most people never hear about. The fiscal break-even. This isn't about whether a well makes money. This is about whether a government can function. For countries like Saudi Arabia, Iran, and Iraq, oil revenues don't just fund an industry. They fund the government itself, hospitals, schools, military salaries, infrastructure, subsidies. When prices fall below the fiscal break-even, governments start burning reserves and cutting programs. Estimates for fiscal break-evens vary year to year and differ significantly by country, but the principle is consistent across all petrostates. This distinction between the field break-even and the fiscal break-even is one of the keys to understanding conflict in the Middle East for the past 5 decades. Back to Qatar, 1976. Iran's representative was the loudest voice demanding a higher price, and the reason was this. The Shah of Iran had made enormous promises to his people. A modern electric grid, a new subway system for Tehran, a large, well-equipped military, railways, universities, all of it funded by oil revenues. And by most contemporary estimates, Iran needed oil significantly higher than $12. Some analysts at the time estimated in the range of $15 to $20 per barrel to fund those commitments without going into deficit. Saudi Arabia said no. The Saudi oil minister, Ahmed Zaki Yamani, left the meeting without warning, flew across the Arabian Peninsula to consult with leadership. 8 hours passed. At just after 10 in the evening, Yamani returned. He told the room that Saudi Arabia would accept only a 5% price increase. And then he announced something that hit like cold water. Saudi Arabia would simultaneously increase its own production from 8 million barrels per day to 11 million. They were going to put more oil on the market themselves. Think carefully about what that means. They didn't just block the price increase, they actively pushed supply higher to drive prices down. For Iran, which needed revenues to fund an ambitious and expensive modernization program, this was a serious economic blow. Now here is where we need to be careful and honest. The Iranian Revolution of 1979 had many causes. The Shah's authoritarian style of rule, deep inequality, religious opposition led by the clergy, resentment of foreign, particularly American, influence, corruption, the repression of political dissent. These were all real, powerful forces building over years. What the oil pricing dispute of 1976 contributed to was economic strain on a government that was already fragile and already losing the trust of its people. It was one significant factor among many, not the singular cause. Anyone who tells you the revolution was simply because of Saudi oil policy is giving you a dramatic story in place of complicated history. What we can say is that economic pressure created by the oil market contributed to the conditions in which existing resentments became a revolution. The distinction matters. With that said, the fact that economic pressure played a role makes Saudi Arabia's decision at that meeting worth examining very carefully. Because Yamani himself told us why Saudi Arabia made that call, and he told us through a story about rubber. In the early 20th century, natural rubber was among the most critical commodities on Earth. Tires, military equipment, industrial seals. Britain controlled the vast majority of supply through its plantations in Malaysia. As demand surged, Britain raised prices dramatically, and it seemed rational. If they had the supply, everyone needed it, why not charge more? The countries being squeezed, the United States, Germany, the Soviet Union, responded by pouring enormous resources into finding an alternative. They found synthetic rubber, made chemically, cheaper to produce at scale, and in many applications, actually superior to the natural product. Within roughly 2 decades, Britain's rubber monopoly had collapsed. Not because the trees ran out, because the price got high enough, long enough, that the world stopped depending on the trees. Yamani had studied this deeply, and he applied its logic to oil explicitly. He said it directly. The Stone Age didn't end because we ran out of stones. The oil age won't end because we run out of oil. It will end when the price of oil stays high enough, long enough, that alternatives become economically competitive and scale up to the point where they can't be reversed. Nuclear power, solar, electric vehicles, synthetic fuels. These are not fantasies. They are technologies that become commercially attractive at certain price thresholds. Saudi Arabia's long-term strategic interest, above everything else, is to prevent oil from crossing those thresholds for sustained periods. Keep prices high enough to be profitable, but not so high that the world is forced to replace you. If you're finding this valuable, drop a comment right now. Tell me what you think happens to Saudi Arabia's influence if global oil demand peaks in the next decade. Seriously, the comments here are genuinely interesting on topics like this, and share this video. This is the kind of analysis most people never encounter, and it changes how you read the news every single day. Now fast forward to 2014, 2015. American shale oil, fracking, has genuinely disrupted the global market. For decades, ending American dependence on Middle Eastern oil was bipartisan political gospel. Suddenly, it was actually happening. American production was climbing sharply. The type of crude from Texas competed directly with the type Saudi Arabia exports. Saudi market share was being squeezed. Saudi Arabia's response was to open their own taps. They pushed production higher and let prices fall toward $30 and $40 per barrel. American shale producers, who needed $60 to $80 just to break even at the field level, started going bankrupt in large numbers. It was a painful period for that industry. Most American commentary framed this as an attack. Saudi Arabia going after American producers. But that framing is incomplete. The United States and Saudi Arabia remained allies throughout this period. What Saudi Arabia was doing was protecting its market position, and more fundamentally, protecting the dominance of oil itself. If American shale had scaled unchecked, it would have permanently reduced Saudi Arabia's share of global supply and its pricing leverage. From Riyadh's perspective, the response was rational economic self-defense, not a betrayal of the alliance. The same logic works in the opposite direction when prices rise too high. When oil approaches very high price levels, governments and consumers start seriously investing in alternatives. Supply chains for solar, batteries, and electric vehicles build out. Once those sectors achieve sufficient scale, their costs fall, and they don't get expensive again, the transition, once started, becomes self-reinforcing. Saudi leadership understands this dynamic very well. This is why you need to view Saudi decisions through this lens consistently. Their partnership with the United States is real and has delivered real benefits to both sides. American military presence in the Gulf protects Saudi Arabia, and stable oil supply benefits the American economy. But when those interests genuinely diverge, Saudi Arabia has historically followed its own economic logic. Not because they are disloyal by nature, but because their situation gives them very little room for anything else. With the overwhelming majority of government revenue tied to oil, protecting that revenue stream is not optional. It is existential. Iran's situation was and remains different because the numbers are different. Their oil reserves, spread across a much larger population, created a different and more urgent set of pressures. They needed higher prices faster. That urgency, combined with the economic strain of the late 1970s and all the other political tensions building at the same time, contributed to an environment where revolution became possible. These are different situations producing genuinely different strategies, not simply a story of Saudi Arabia as villain and Iran as victim. Now look at where we are today. The global energy transition is accelerating. Electric vehicle adoption is growing faster than many analysts expected even 5 years ago. Renewable energy costs keep falling. In government offices and planning departments in Riyadh, serious people are running these calculations and watching these trends carefully. Saudi Arabia's Vision 2030 program, the plan to diversify the economy into tourism, technology, entertainment, and other sectors, exists precisely because the people running the kingdom understand that oil dependence is a long-term vulnerability, even if oil remains dominant today. The transition is real, it's just slow. In the meantime, the kingdom has to walk a careful line, keep prices in a range that maintains profitability, prevent competitors from taking permanent market share, avoid triggering a price spike so severe it accelerates the alternatives permanently. It's a more complex balancing act than it looks from the outside. This is not a morality story. Countries make decisions based on what they have and what they need. Saudi Arabia has extraordinary oil reserves, a relatively small population, and a government that depends on those reserves to maintain its social contract. Every decision flows from that reality. Every alliance, every production cut, every supply increase, it all comes back to the economics of what they're sitting on and how long it can last. The next time you read a headline about Saudi Arabia siding with the United States on something, the right question to ask is not whether they're being loyal. It's whether American and Saudi interests happen to align on that specific issue. And the next time you read about Saudi Arabia doing something that surprises an American ally, the right question is what Saudi Arabia's own economic interests are in that moment. That framework will get you further than almost anything else. Oil, for the countries that depend on it most, is not just a commodity. It's the foundation of the social contract, the source of government legitimacy, and the only thing standing between stability and crisis in many cases. Understanding that doesn't excuse any particular decision, but it does explain them. If you made it to the end of this video, genuinely thank you. This is the kind of content that takes serious time to research and put together, and the only way it reaches more people is through you. Subscribe if you haven't, share this with someone who you think would find it genuinely useful, and leave a comment below telling me what you think the biggest geopolitical risk in the energy space is right now. I read them. I'll see you in the next one.